All right, so it's 11:05. We have a bunch of people registered, but for the interest of time and to respect everyone's time who's on right now, we do want to get started. So without further ado, first of all, I want to thank everyone for joining us on a Saturday morning. I really appreciate your time for registering and coming on the webinar. Just want to let you know that the point of the webinar is going to be to educate you guys on a different type of real estate investment. Before I talk more about that, I want to introduce myself for those of you that don't know who I am. My name is Ahsan Raza. I'm a local real estate agent in the Greater Toronto area, and I have been in this business for the last 12 years now, helping people buy, sell, and invest in properties here in the GTA. Now, the last few years, we're trying to figure out ways on how we can help our clients diversify their real estate investments. You have your traditional single family homes that you can invest in, your pre-construction, your multiplexes, but a lot of people don't know that, real estate investments comes in different levels and different depths. And one way of getting some exposure into real estate is what we're going to be talking about today with my guest speaker, who I'm going to introduce shortly, is through a company called Equiton. And they basically give you the exposure into real estate and allows you to get that exposure without having to do the day-to-day management of a landlord. So what I always like to point out, and I guess maybe the goal of the investment of the webinar today is going to be to really understand how important it is to diversify your real estate investments. And there's so many different vehicles, and this is just one way that I think you guys can find value in. So without further ado, I do want to introduce my guest speaker, Cosme Reveredo, who, for those of you that might have seen us on a podcast in the last few months, I did a podcast with him. But Cosme is a representative of the company that we are teaming up with today. And I'll give you a quick intro, and Cosme, I'll let you take over from there.
Sure.
Cosme is a senior associate at Equiton Capital. He's a dedicated finance and business development professional, in addition to being a real estate investor himself. Having previously held progressive position in finance with one of the largest communications and media companies in Canada, Cosme's focus turned to private equity, real estate investing. He enjoys assisting individuals who are looking for strong risk-adjusted returns, exposure to private real estate investments, and those seeking a diversified portfolio. Keyword, diversification again. So Cosme, I'll let you take the mic. And without further ado, the floor is yours.
Yeah, thank you. Good morning, everyone. Ahsan, hopefully everyone can hear me really well. Thank you for allowing me the opportunity to hop in. Just to add from the introduction, that was a great introduction, by the way. Thank you for that. Of course, my name is Cosme, a senior associate here at Equiton. Equiton is a private real estate investment firm here in Toronto. I've been involved in real estate investing, since my early days of university. I realized early on just how pivotal exposure to just real estate investing and the power of real estate in building generational wealth, right? And that's really today the focus is going to be largely on how to build wealth investing in real estate passively, and that's a key word as well that I'm going to maybe stress a few times throughout this presentation. But more importantly, it's just finding solutions to invest in real estate, really without many of the hurdles right now that are prevalent in the ownership or to ownership of real estate, right? So, in my conversation with clients daily, there are generally three major hurdles to real estate investing. Austin sort of touched on a few of them. Number one is that massive down payment typically required. Number two is the need for financing, especially in today's interest rate environment. And just number three, the ability to manage the property, right? Now, some people in my conversations, to be quite candid, they enjoy property management. They really do enjoy it as a sort of a hobby, I guess, and they're really good at it. Some other folks not so good at it, right? And they're not so great at managing their property. But more than anything, they just don't have the time to commit to managing properties, right? Life can get busy. There's a lot going on. Managing a property sometimes is a part-time job on a good day, right? So not a lot of folks enjoy it. And for those that don't enjoy it and or just maybe not in the financial position to have a direct real estate investment, or they just don't want the hassles of managing a property, passive real estate investments, end up being sort of an excellent option to consider. And that's really what, I'm going to be speaking about today. I'm just going to share my screen, and maybe if you guys can give me a thumbs up when you see my screen, just give me a shout. How does that look on your end? Good.
Yep, I can
Yep.
see it. Can everyone
Awesome.
else?
Okay. I see a lot of thumbs, so that's good. Um, so before, I think we take a deeper dive into the investment strategies, I thought it'd be useful to maybe touch on the company as well. You can see sort of our slogan or our tagline here. We see what others don't. I'll sort of circle back to that as I move forward here. But really, more than anything, I want to take a deeper dive into the company before we even hop in, because we've got a pretty strong track record of success, right? Especially during times where, in the last few years, where there's been a lot of challenges prevalent in the economy, we've remained quite resilient, and we've continued to forge a strong path forward. So, as an organization, we were founded back in 2015, so almost 10 years now, with only 3 employees. And today, as you can see, we manage a portfolio of just over $1 billion in assets under management, just about 200 employees spread across 2 different offices right now. This morning, actually, I'm speaking to you out of our Burlington head office, but we also have an office right on Bay Street in downtown Toronto. For those familiar with the downtown Toronto core, we're growing organization. The exposure is getting there. This is just another representation, sort of our growth. You can see back in 2016, of course, a portfolio just around 22 million. And again, just as we stand towards the end of March of this year, just over $1 billion in assets under management. And Equiton really, it's what I would consider and call out as a fully integrated real estate investment firm. And that's just really a fancy way of sort of saying that, we do everything in-house here at Equiton. So for example, when I touch on today our residential fund specifically, just know that all of our property management is done in-house, right? When I'm touching on sort of our Equiton development opportunities, know that our development team, through our Equiton developments arm, presides over everything to do with the project, right? So this is all to say that everything is done within the Equiton ecosystem, which is rare sometimes, especially when it comes to development, standalone development opportunities. What you find typically with developments is that typically there's a capital partner that brings money to the table, partners with a developer, and then together they sort of execute upon the project. We do everything fully integrated here at Equiton, okay? But I get a lot of questions about, when I speak to my clients, they typically ask me a question about, why invest in private real estate? And in Equiton, as I sort of touched on earlier, we are a private and a passive real estate investment firm. Excuse me. And those are two things that are really important to call out. So, for all the folks on the call today, this is a passive investment. So what I mean by that is you're getting exposure to physical real estate. However, you do not need, obviously, that massive down payment, financing, or more importantly, the need to be a landlord. This is strictly a hands-off investment. You're participating in the cash flow as well as the appreciation of the assets, and you're leaving the ongoing day-to-day management to the experts and the professionals here at Equiton, right? And that's really that's really important to highlight. But also the second part of that is we are a private investment. So this is important in the sense that we are not a stock or a mutual fund. We are not traded on any exchange, a public exchange. And because we are not traded on a public exchange, we're able to give investors sort of that investment that is a little bit more stable and consistently performing without having to deal with a lot of volatility, right? And I'll sort of highlight that on this next slide, simply because the reason we can provide that consistency is due to the fact that we invest predominantly in privately owned Canadian apartments, right? Hopefully this slide is coming through well on the other side. I know it's a little busy, but what you can see really in this slide, in this chart here, is that over the past almost 40 years, the asset class Canadian private apartment buildings has been relatively stable and has weathered multiple global crises, right? More recently, of course, the global or COVID-19, the global pandemic, of course, and then more recently, the inflationary environment that we've, sort of been exposed to in the last year and a half or more. Again, the Canadian private apartment space has remained relatively consistent. You don't see that roller coaster type of performance that you might see with maybe a public investment, right? So that's why I really wanted to focus on the fact that we are private as well. So at Equiton, really, we try to keep things relatively simple in the sense that we've got three investments and really two different styles of investment. So on the one hand side, we have our funds, and on the other hand, we have investments in land development. Now, again, this slide is a little busy with information, so let me pick it apart for you. And more importantly, let me focus on the two different styles of the investments, right? So with respect to the funds, a few things to keep in mind. The funds, they're diversified. So if my client makes an investment in either of our funds, they get a diversified exposure to a portfolio of assets, right? And that diversification, Ahsan touched on earlier about diversification, right? That's important because that diversification, what it does, it lowers and spreads risk, right? The second thing to remember about our funds is they produce a cash flow. So both funds pay a monthly distribution to our clients. You can think of this as being identical to receiving rental income, right? So for those folks on the line right now that own an investment property, simply think of it as no different than how you generate investment cash flow on your property as well, right? We're doing the same things in these funds. We are providing rental income to our investors that's being generated from our assets, okay? The third thing to remember about the funds is that they're relatively flexible. So if you need to redeem your funds for a specific reason, life happens, emergencies happen, we will honor the redemption. However, I do want to stress and caution to everyone, this is not a short-term investment, right? You should not be day trading our investments, okay? Because after all, we are investing in physical real estate, and we do look for a commitment of a few years in these investments, and you should be comfortable with that, right? Again, we're investing in real estate. It takes time for one to put the money to use in real estate, but also as in a real estate investment, it takes time to extract value out of it as well, right? So, and then finally with the funds, I'll leave you with, as you can see on the screens, our funds target a return of anywhere from 8 to 16%, depending on the fund that you're investing in. And again, fairly strong net returns. But on the flip side, on the far right side there, you see our development investments. So developments, keep in mind that we are investing in the physical construction of typically a mid-rise condominium, and investors generate their profit through the completion and ultimately the sale of those units. Now, very important to note, we're not discussing the sale of pre-construction units in this strategy, where you buy a unit, you make your installment payments all the way up until occupancy. We're not talking about that. We're talking about an opportunity to invest alongside Equiton on the physical construction of the building. The sources of the profits for our investors in this investment are generated from the sale of those units ultimately, and your exit strategy is that sale to the end users, right? And I'll touch on that a little briefly as well after. This strategy is important to understand that we're acquiring a parcel of land. We are taking it through the rezoning process, to get to the site plan approval. Upon pre-sales, and typically here in Ontario, obviously in Canada specifically, we need to sell a specific or certain number of units before we can put a shovel in the ground, build out the foundation, build up the multiple floors, etc., and then hand the keys, of course, over to the end user. That's when the project wraps, and that's when our investors start to see their returns. I'm stressing this simply because it's important to note that with these development investments, your capital and profit are recognized upon the completion, which in some cases with some development projects can take anywhere from 5 years in terms of an investment time horizon, right? Just to, again, put a bow on this development option, it's important to recognize that an investment in land development is not a diversified investment in terms of investment into a standalone development. It's a concentrated investment, meaning you are investing in one specific parcel of land in one specific location for a given time period, okay? The second thing to note about these development investments, unlike the funds, there are no monthly distributions that are paid out, right? We are constructing physical real estate. There is no cash flow that's being generated on a month-over-month basis from the manufacturing of this building. In fact, there's more or less cash outflows, right? And you do not recognize, again, your profits until the completion. And then finally, with the developments, unlike the funds, there's no flexibility with respect to redemptions here, unfortunately. If you invest in a land development project today, your capital is tied up until the completion of the investment. You cannot call me in year 2 of 5 and say, "Hey, Cos, sorry, I need my capital back." Unfortunately, I cannot accommodate that ask. Okay. Now, for that level of risk and restrictions, we'll say you are handsomely compensated in the sense that our development opportunities typically provide a return of anywhere from 16 to 20% on an annual basis. So that's a general rule of thumb when it comes to these development investments. Our goal is really to double an investor's money over a 5-year period, right? So really just to summarize again, this slide at a very high level, these investments are different and maybe suitable to different people in different situations, right? So if you're someone, that's maybe closer to retirement, you're looking for some consistent cash flow to supplement your retirement, the funds make more sense for you, right? If you're younger and maybe have a longer runway towards your retirement and your retirement savings, um, maybe a development investment may make more sense for you, right? And I unpack a lot of this with my clients really during one-on-one sessions. That's really focused on discussing the alignment of our investments with their client, with their objectives, for example, as well as their financial position at the time. That's something that, again, for anyone that's interested, reach out to us. And after this webinar, he'll put us in touch and we can sort of do a deeper dive as well. Okay. Final note before I leave this slide. Our fund investments can start as low as 10,000. So our income and development fund, which is in the middle on this slide here, it's a minimum $10,000 investment. Our apartment fund and our investment into land development, it's a minimum of 25,000. And of course, you can leverage the use of all registered plans, to invest as well. Okay. I'm sort of zooming through a lot of these slides, guys, just for the interest of time. There's a lot of information, and I want to, make sure we can get through as much as we can. So just give me a quick second, take a sip of water. So let's take a deeper dive then into the investments at a higher level, starting with our apartment fund. Our apartment fund is the oldest fund and consequently the largest fund. From a strategic standpoint, it's a simple strategy to understand simply in the sense that it's very similar to if anyone on this call again would go out and purchase a real estate investment property. It's a long-term buy and hold strategy. We're investing in high density apartment buildings. So we're not buying individual units or duplexes, for example, high density residential real estate. And we employ what we call a value add strategy. So we acquire underperforming or unoptimized buildings and we actively manage them to unlock their value. Okay. In terms of size, the size of this fund is absolutely nice. So just shy of $1 billion in assets under management, over 2,700 individual units spread across 34 different buildings. There's over 11,000 active investors in this fund. Geographically speaking, the majority of our portfolio is in Ontario right now. Of course, Ontario represents our home base. However, you can see we do have a couple of buildings out in Edmonton, Alberta as well. I believe there is somebody on the call from Alberta. So, we did expand into Alberta in late 2022 as well. So the mandate of the fund really is to be Canada-wide. But that being said, of course, given most of our resources are in Ontario, naturally we're in Ontario. We have a larger presence in Ontario. I've included a couple of buildings that actually Equiton ended up acquiring late last year. I'll preface this with a note that, last year, for anyone that understands sort of the environment in terms of transaction volume, it was a very tough year for acquisitions in this space, as you can probably imagine. But yet, our team at Equiton, we were still active and found ways to strategically acquire strong buildings to add to our already strong portfolio. This acquisition here was actually in London, Ontario. It's our second property in the city. We do like London quite a bit. It's an extremely nice city. It's also a very nice rental market, right? So, secondly, our acquisition in Brantford, Ontario. Once again, you can see that, just to give you an idea of sort of the buildings and the quality of the type of assets that we sort of, acquire and help grow our fund, okay? I do want to touch on the returns because I know a lot of people like to touch on the returns. That's why you're here, of course. The targeted return for this fund is 8 to 12%. You might have noticed that on our overview slide from a couple slides ago. But let's break down that 8 to 12%. So a portion of that 8 to 12% return that you receive is coming by way of cash flow. So roughly 5 to 6%, we'll say at this moment. Currently, the fund is paying out approximately 5.8% on an annual basis, but of course, paid in monthly distributions. Okay. The remaining return is being generated from the appreciation of our buildings, okay, our apartment buildings, right? And that's roughly 2 to 6%. So as the value of our buildings increase, we raise the unit price of the fund, which results in your principal investment going up as well. So there's two components to your return. There's that cash flow piece and then the capital appreciation, which make up your targeted total return of 8 to 12%, okay? I'm just going to show you a bit of a visual of, if someone was to invest $100,000 since the inception of the fund, you can see, of course, they're sitting very pretty right now, just shy of $200,000 in terms of their investment. But really the main thing I want to highlight on this slide, I touched on volatility earlier, right? And I touched on the fact that, again, with that private Canadian market, Canadian apartment index and apartment space, you don't see a lot of roller coaster in terms of returns, right? So you can see really in this slide the consistency of this asset class and the consistency of this investment, right? And that's really what I stress to my investors when they're looking at this fund, is the stability and the consistency of this investment. That's why the majority of our investors love this fund. It's a nice balance to your investments, maybe in the public market or even just physical real estate, for example, where again, you'll notice in the public market, the price of the share can be very volatile under different market conditions. This sort of helps insulate you from that, right? So, and again, just a little bit of context in terms of the returns. Last year in 2023, our fund returned 10.81%. Since the inception of the fund, we're roughly around 9% return. 2 years ago, actually, the fund returned close to 14%. This is all to say that, again, on a year-to-year basis, we really do target between that 8 to 12%. Some years we may outperform, but of course, our range is that 8 to 12%, okay? Just to maybe put it all into a nice summarized nutshell for you here, just to wrap on the apartment fund. Here's a good summary slide of what we talked about. We talked about the returns being generated from cash flow and appreciation. The one thing I think I touched on earlier, but I didn't do a deeper dive into, you can, of course, use registered funds to invest. So a lot of my investors come by way of investments through their RRSPs, TFSAs, LIRAs, for example. And that's a bit of a game changer, right? For the most part in real estate right now, if you were to go and buy a physical property, you typically cannot utilize a lot of these registered funds, right? Especially LIRAs, for example, in TFSAs, for example. You're not able to maybe leverage it to just buy a real estate property. You get the option to do that, here as well, okay? I do want to touch on the other fund here at Equiton. It's called the Income and Development Fund. Now, this fund shares many of the same characteristics as the apartment fund, in a sense that it pays out a monthly cash flow. It's steady and consistent in terms of its returns. We have yet to miss a return or a distribution in this fund, similar to our apartment fund, of course. The only difference here, well, let me touch on the returns first. The fund targets a higher return. It's a 12 to 16% return. And the reason for that is this fund is a bit of a hybrid. And what I mean by that is there's income producing sources in this fund, as well as exposure to high growth development investment. So it's sort of why this fund was slotted in the middle. If you remember that summary slide that I showed you earlier, it was sort of in the middle, is because it's a best of both worlds, okay? But let's touch on the two elements that actually driving the returns in this fund. So we've got income producing side in this fund that's driven from commercial properties. And the second piece of this fund comes from the second piece of the income producing side comes from a small exposure to private lending as well. So that represents a 6% yearly return. Again, that's paid in monthly distributions in this fund as well. And that's coming from the income producing side. But what I really want to touch on is the second part. So on the far right, you can see the exposure to development projects. And quite candidly, this is what makes up the majority of the returns in this fund, is the development projects. So as I noted earlier, at Equiton, we have development projects in the pipeline. As these development projects complete, they pay a special one-time lump sum distribution to unit holders in this fund. Okay. Um, Earlier, I mentioned that Equiton, our development investments rather, on their own are concentrated. So if you're investing in single standalone developments, they're concentrated investments. But for individuals that, maybe didn't have the minimum 25,000 to invest in a development, but also for individuals that just maybe didn't want to invest in one specific development, this fund actually gives you a diversified exposure. There's that word again, diversified, but it gives you a diversified exposure to a bucket of developments. Okay. So this fund may be of more interest for those folks that, maybe don't want to tie their money to one development, but want exposure to development profits, right? And that's why, again, maybe I'll touch on, some of the assets that roll into this fund, but more specifically, let me touch on the development. We have a 96 TAC townhomes that's nearing completion towards the end of 2024, so Q4 of this year in Guelph, Ontario. So for anybody that's in Guelph on the call, it's on Woolwich Street in Guelph. Gives you a nice aerial view of the 96 TAC townhomes. They're in construction right now, so if you were to drive by, you'll actually see quite a bit of work has been done on them. Again, targeting a completion rather of Q4 of this year. Our second project in this pipeline in this fund is actually a mid-rise condominium just west of the downtown Toronto core. It's on the Queensway in Etobicoke, for those familiar with the area. 11-story build, just shy of 200 units. Again, this one is slated for completion at the end of 2026, so Q4 2026, we'll say. And finally, we have a mid-rise condominium in the east end of Toronto, just over 300 units, just around the Scarborough Bluffs area, for those that are familiar with the area. This one is slated for completion at the end of 2027, so Q4 2027. So you can see that Q4 2024, Q4 2026, Q4 2027, we've got 3 developments in the pipeline. For the folks that are staying in that fund long enough, you'll see special lump sum distributions upon completion of those projects. Okay. So finally, again, I'm looking at the time and I just want to be cognizant of our time here. I do want to touch on our standalone developments, simply because I am really excited, and at Equiton, we're really excited about this project as well. Standalone options I mentioned earlier, they can generate anywhere from a 16 to 20% return on your money. Again, the goal is to sort of double your money over a 5-year period. This right here is our open offering right now, open for funding rather. So this development, it's a 12-story condominium. It's in the Broadview and Danforth area of Toronto. For anyone on the call, which I think the majority of people are from Ontario, but for anyone that's in that Toronto corridor, you'll recognize that Danforth and Broadview area, a very vibrant area. We're going for approximately 355 units with a projected completion about Q4 2028. Again, we're targeting a total return on this project of just over 103% over that 5 and maybe 1.7 year time horizon, which again annualizes out to 20%. So again, as I touched on a couple of times, again, over that 5-year period, the goal is to sort of double your money. We acquired this parcel of land actually for 26 million earlier this year. It was actually appraised by an external appraiser, CBRE, for 33.5 million. So we've already made money just on the buy. So this further speaks to our approach and really our core belief. If you notice from my main slide, my title slide, we see what others don't, and that really sort of encapsulates this. Is that again we're out there acquiring selectively, but of course we understand what we can do with that parcel of land as well. Our team in-house understands what we can do with that, and that's where really the value add is created, right? So there's different ways to make money in real estate, as you guys will be familiar with. You can make money on the acquisition. You make a lot more money on the holding, of course, but you can also make money on the exit as well. So this project, we're already off to a pretty favorable position just on the acquisition. Okay. I sort of touched on this slide again, so I'm not going to spend too much time here. But I do want to touch on the timeline. So here's just a quick overview of the development cycle and the expected milestones. So as I mentioned, the land was acquired in Q1 of this year. Our development team has already been working with the municipality on permitting and rezoning. We anticipate this process, and again, we call this the entitlement process. It's typically the longest stage, sometimes in a development cycle, but we anticipate this process sort of wrapping up by Q2 of 2026, upon which we will launch sales and marketing for the project. And again, typically the benchmark is we target pre-sales of roughly 70% of the units prior to taking out a construction loan and beginning that construction process. We've pegged that construction process to be just roughly around 2 years, we'll say, and expected to wrap up in late 2028, early 2029. So again, I'm sort of rushing through all of this, but if there's interest in sort of diving deeper into standalone developments on its own, again, express your interest to us, and we can find a way to connect and discuss in more detail. I can spend 30 minutes talking about developments on its own. So but I don't, obviously, for the interest of time, I don't want to do that. But what I'll do is I'll sort of, wrap on this one. I communicated earlier why we love this project and why we love this area so much. This Danforth and Broadview area, again, is one of the most vibrant and highly desirable areas to live in Toronto. If anybody's around that area or is from that area, you can probably, add value and probably back my sentiment up. The reason why this is such a highly desirable area is because what I like to call the golden triangle. What I mean by that is there's three major pieces of transit infrastructure, all within a 5-minute distance of the build site. So we're 5 minutes from the DVP, an extension of the Gardiner, which is an extension of our major highways here in Toronto. We're within 5 minutes of the Broadview subway station, and we're also within a short distance of the Danforth GO station. So it's very rare, guys, to have this type of accessibility to transit infrastructure when you're looking at a parcel of land, but that's really why this land stood out to us. And for those familiar with the Greektown in Toronto, we're very close to Greektown, of course. You'll be well aware rather, of the vibrancy of the areas. There's just great restaurants, bars, just a great, quaint neighborhood. Just a good neighborhood to raise a family, and just to live overall. So for the end user that ends up occupying the units in this build, there's no doubt that they're going to have a great time. With that, guys, I'm actually a little bit out of breath, so I'm going to wrap it there and maybe just hop to the Q&A. And again, I'm looking at the time. I think we just have under 20 minutes left, so I'm sort of just going to cut it off right there, Ahsan.
Thanks so much, Cosme, for the wonderful presentation. So for those of you guys that have any questions, we do have the chat group open. Feel free to type in your questions over there. Cosme, I actually already have a couple of questions here in this chat and a couple offline. First question, I believe from Zamir. You mentioned about your company being a privately owned and it's not a public company. So the question is, how does not being a public company allow you to be more stable?
Yeah, so that's a great question. So if you notice with public investments, guys, if you were to make an investment, in any public investment for that matter, it's traded on a secondary market, right? So there's, influences that occur, whether it's geopolitical issues across the globe sometimes, or just something as, close to home, like our inflationary environment sometimes. It'll impact the value and the stock price, right, of your share that you're invested in. So what you'll find with returns, they'll typically be, you'll see that roller coaster pattern with your investment, right? Now, again, stock market investing, depending on your strategy, can also be a long-term strategy, should be a long-term strategy as well. And over time, you'll probably end out ahead. What people find with public investments, though, they tend to buy high and sell low, because again, it's based on emotions, right? With our public or private investments, rather, so our apartment fund specifically, the unit price is driven by the valuation of our apartment buildings in the fund. So we get all of our buildings appraised on a quarterly basis by an external appraiser. So we use CBRE for anybody wondering. That external appraiser, as they come in and do their appraisals on our buildings, it'll be reflected in our unit price. So our unit price is not going to move up and down like a roller coaster, so to speak. It's going to be stable and consistent, especially if we're consistently performing with our buildings. This is why I say it's a little bit more stable. We have yet to miss a distribution in the fund, simply because we can, again, model out our projections and be able to provide a risk-adjusted return just based on the fact that we understand where the market is, and our unit price and valuation is driven by those external appraisals on our asset value and not driven by emotions.
Awesome. Thank you so much for that answer.
No problem.
Next question from Asad. How does Equiton differ from the simple investor?
I'm going to be I'm going to be very honest. I don't know too much about the simple investor. I know I do see a lot of the ads, of course, on the radio, I believe, or TV maybe. I don't know too much about them. So I really can't speak too much about the simple investor. But maybe if you want to take that offline, Asad, and maybe give me some context as to what you're talking about, and maybe I can give you a bit of a background on how we differ. Is that fair?
That sounds like a plan.
Yes.
All right, questions are coming in. The next question we have is from Fatima. She is asking, sorry if this was covered as I missed the beginning. What's the typical investment horizon? And do you anticipate an exit for every investment over a period of time based on past experience, or are some of these indefinite holds?
So we asked for a soft holding period of 3 years on our funds specifically, Fatima. So, again, as I started stressed earlier, we are investing in real estate, right? Physical real estate. So we do ask for a longer holding period. Again, we do ask for a soft 3-year holding period simply because it takes time to put the capital to use. It also takes time to extract value out of real estate. Having said that, there is the flexibility to redeem at any time. If you were to redeem prior to that soft 3-year holding period, there is a bit of an early redemption penalty. Now, just keep in mind, guys, this penalty is not there to penalize investors. Is there more or less to incentivize a long-term holding period. Because again, we are investing in real estate. We do want to have time to put that money to use and obviously extract value out of it. I will say one thing, the majority of my investors and the majority of the investors in our funds actually invest by way of registered plans, right? So if you're using an RRSP, for example, especially if you're just fairly young in your career or just fairly young in life, for example, you may have a long runway before you need to redeem your RRSPs or TFSAs or LIRAs, whatever it is. So the holding period typically doesn't even come into question sometimes, simply because again, you have a longer runway to let your investments grow and compound. So yeah, with the respect to the holding periods, we do require a soft 3-year holding period. There is obviously options to exit earlier, but again, just keep in mind there is that early redemption penalty if you were to leave prior to 3 years. Okay.
Perfect. Thank you. Next question. How can we reach out to initiate investing?
Yeah, I would say get in touch with us, and he'll put us in touch in terms of breaking out a one-on-one consultation. So just to give you a little bit of context, if anyone is interested, Ahsan obviously will put us in touch. I go through a bit of a consultation with all of my investors, just so everyone knows. There's a criteria involved in order to invest in these private investments. There's what's called an eligibility and a suitability requirement, and I'll flesh out those details with you on that consultation. And I'll probably just get ahead of this because someone might ask this, in the chat as well. All of our activities are governed and regulated by the securities commissions in the respective provinces and the Canadian Securities Administrators. Equiton is what's referred to as an exempt market dealer. They are governed by the securities and administrators as well. I personally, as a dealing representative, I am governed by the Securities Commission as well. So again, there's criteria involved in order to invest, and I'm happy to touch on that during our consultation as well.
Perfect. Thank you, Wasim, for that question. Our next question is from Sherry, and she's asking, what is the minimum amount to invest?
Yeah, so the minimums can be as low as 10,000. That 10,000 represents the income and development fund that I was speaking about. In order to invest in the apartment fund specifically, the minimum is 25,000. And then our standalone developments, the minimum is 25,000 as well.
Perfect. Next question from Saptain Panju. How much leverage mortgage do you use of the apartment fund? Example, LTV.
Yeah, that's actually a great question. So across the portfolio, sorry, I don't know how to say that name, but across the portfolio, the mortgage debt to book value is actually 45.9%. So we're nowhere near being over leveraged. And that sort of speaks to our approach as well. So we have a very conservative approach when it comes to acquisitions, for a couple of reasons, obviously. One, we go in any acquisition that we make, guys, we target a longer term horizon. This is why I stress that we're long-term investors. We even go in and acquire with a longer term in place. So almost we look for 10 years really, and in a fixed rate as well. So a lot of our portfolio right now across the board, our weighted average interest rate across the board is just 3.06%, which is incredible, especially in this environment, right? And the reason for that is a lot of our acquisitions were done on a longer term holding period on a fixed rate. Just so everyone knows as well on the call, the expected time to maturity on our portfolio of apartment buildings is about 6.5 years, we'll say. So with respect to just financing risk, we've sort of insulated ourselves from that simply because of the way that we go about acquisitions and being conservative in our approach. Hopefully that answered your question.
Yeah, and if you guys have any follow-ups, like we can always connect you guys offline later on, which we'll be doing anyways with the recording and all that stuff. So we'll just get to the other question right now that we have. Fatima is asking, do we need to be accredited?
No. So quite candidly, even non-eligible investors can invest. They're just capped in how much they can invest. But of course, there are three sections. There's the accredited investor, the eligible investor, and then the non-eligible investor. But again, everyone can invest. You're sort of capped how much you can invest if you don't qualify, at the very least, as an eligible investor. Okay.
Perfect. Thank you. And Amir Abbas is asking, how do you value your land development share over a year-over-year basis if the project is still in the construction phase, buying the share at year one or last year?
Buying the share at year one or last year. I'm not sure what you mean by the last part there, but really the land development is projected out obviously projected out right off the top. And again, but development, you have to understand, is a margin business, right? So our projections are based on how much it costs to really build a building or build a mid-rise condominium versus how much we can, of course, sell it for. And that spread is really what we share with our investors. So we don't necessarily do year-over-year projections on our developments. It's more or less, projected out front. And it's really driven by the price that we can generate in the market when we go to sales, as well as how much we can save in terms of just the expenses related to building out or constructing a building, right? So.
Right. Okay, good. Some good questions coming in. Yahya is asking, how do you ensure transparency to your investors? How frequently do you share the information? Any online mechanism to view one's investment value? That's a really good question.
That's a great question. I'm glad you asked the question. So with respect to transparency and governance, we produce quarterly statements in all of our investments. Not so much for the developments, of course. I mean, quarterly updates for developments, but there's nothing really in the form of statements to show for developments. But with respect to the funds, you will have access to quarterly reports. With respect to governance, our annual reports are produced and audited by a third-party auditor. So we use Grant Thornton as our auditor. So they come in and obviously do. They're one of the more, they're one of the larger, audit and assurance firms here in Ontario. They come in and obviously take a look at our books as well. With respect to the transparency, you can actually download all of these reports as well as our annual reports right off of our website, actually. But of course, if you're one of my clients, I share all of that information with you directly. You'll also have access to all of that information if you are an investor through our online portal as well. So you can download all of those reports. We're fairly transparent, guys, to the point where even in our annual reports and our quarterly reports, we provide the addresses to all of our buildings and our assets. So again, if you live in the area and if you're by one of our assets, feel free to drive by and have a look. You can't go inside, of course, but feel free to drive by and have a look. Yeah, we're fairly transparent in that sense.
Great, thank you.
And sorry, the second part of your question, I think, was, is there an online mechanism to view your investment value? That would be the investor report.
Yeah, thank you, Yahya, for the question. Mohammed Rizwan is asking, what are some common pitfalls or challenges investors face when using registered funds for real estate transactions, and how can they be mitigated?
So I think I maybe want to clarify, what do you mean by real estate transactions? Keep in mind that if you're using registered funds to invest in our funds, you're investing in a diversified group of assets, of course, right? And your performance of the funds, the distributions will be paid to that registered plan or whatever you're using. And of course, you have the same 3-year holding period that any other investors would have in terms of the time horizon and the investment horizon, and you're free to leave at any point, of course, subject to those early penalties. The only other transaction fees to be concerned about when it comes to investing using your registered plans in our investments is we use a third-party custodian in order to invest registered plans. So unfortunately, we cannot take money from your big banks like an RBC, TD, CIBC, etc. We do need to open a registered plan account for yourself at one of the 2 trust companies that we use as a custodian. So we use Olympia Trust and Odyssey Trust, if you guys want to look that up. So we invest through that trust, through your account at that trust. But of course, when it comes to financial institutions, they all have fees. There are fees associated with opening an account at one of those trusts. Again, I can dive into those fees with you on a one-on-one basis if you'd like. But that would be, in terms of transaction cost, something to be aware of as well.
Perfect. Thank you for that. Cosme, I have a couple of offline questions as well that someone
Sure.
asked you. They're saying they have about 15,000 saved in their RESPs for their children.
Yeah.
Number one, do you also use RESPs as an investment vehicle? And number two, if you do you recommend that I transfer all of the RESP amounts into Equiton, or should I start off by investing maybe half of it to see how the return is?
Yeah, I mean, again, the second part of that question, I think, that's where, when we do a deeper dive, we'll sort of flesh out a few things, right? We want to flesh out what's your propensity for risk, right? What's your risk tolerance? How comfortable are you in an investment, in a private investment, for example? So a lot of that thing is maybe more personalized to individual situations. But again, I'm happy to dive deeper into that in those one-on-one consultations. The first part of the question is, yes, we do leverage the use of RESPs as well. I have several clients that have their RESPs for their young children just started, of course, because they want to help compound that growth by the time that they get to the age of 18, and they want to obviously leverage the use of those RESPs. So the short answer is yes, we can use RESPs. In terms of an individual strategy, that's more of a deeper conversation, because I need to really get a better understanding of the individual's position and sort of what what their goals are for their children as well as for themselves, right? So.
Right. Okay. And a follow-up to that question, again, regarding RESPs, is you mentioned 3 different funds. If I want to transfer my RESPs, which fund would you recommend, given that I would need the money for my son's college or university when he's 18?
Yeah, so I guess it depends when he's making the investment, right? Is the son only a year old, or is the son 16 years old, right? So a lot of that will impact the answer. I would say if you're just starting out, when your child is just maybe very young, of course, maybe the higher growth investments might make more sense, right? So the income and development fund, for example, if you want something more flexible, or even an investment into land development, because of course, if you're investing for your children. If they're 2 years old, for example, I don't believe a 5-year or 6-year holding period is going to impact that in terms of the returns that you're not going to need that RESP at that point, right? So yeah, again, this is more of an individualized scenario as well. But again, it really depends on when you're making the investment. If you're making the investment for your child when he or she is 15 years old, that's a different conversation, right? So.
Gotcha. And one more offline question I have is, how does your company weather the storm in the last 2 years with rising interest rates? And
Yeah.
have you seen returns come down in the last couple of years?
No, actually. So, well, I shouldn't say no. The 2 years ago, we in our apartment fund, our returns almost touched 14%. Last year, it touched just about 10.8%. But in terms of weathering the storm, I sort of touched on this a little bit earlier with respect to how we acquire and how we model out our projections, right? So we model out our projections over a 10-year period. But again, we're very conservative in our approach, right? And that's why we, again, lock in longer term fixed rates, simply because it helps us with our risk adjusted projections, right? And that's why we can comfortably say that we can, return between an 8 to 12% return, simply because we've modeled out some of the scenarios whereby, when we've been facing some of these headwinds in the last few years, especially with the interest rate environment, we've sort of been able to navigate that fairly well, simply because of how we were positioned when we acquired our buildings, right? Very low debt to LTV ratio, obviously, across our portfolio. Very low mortgage interest rate, weighted average interest rate, just around 3.06% right now in the full portfolio. And again, staggered exits when it comes to maturity dates as well, just about 6.5 years, I think, on average, in terms of our maturity on our existing mortgages. So yeah, we've been able to weather it simply because of the conservative nature of how we approach our acquisitions.
Perfect. No, thank you so much. We got one more question here, but I think due to the interest of time, Siptin, we may have to, you know what, let's try to get it in there. Cosme, if you have a couple minutes, yeah? Can you go into a bit more detail on how you value the apartment fund?
So the
Example
apartment fund,
process.
yeah. So the capital appreciation of the building, of course, is driven by the appraisal reports that we'd get from CBRE, who's our external appraiser. They do that appraisal on a quarterly basis. With respect to how apartment buildings maybe add value, or how to increase the value in an apartment building, just know that multifamily apartments, they're treated very differently than single family homes, of course, when it comes to valuations, right? So for a single family home, guys, of course, listen, you're very familiar with this. In order to value a home that you want to sell, you're likely looking at comparables, right? Comparables in the area, comparables just on the same street, for example, or the same product type, and that's how you sort of position or price that property. Very different when it comes to multifamily. Multifamily apartment buildings are treated like a business. The valuation is truly driven by the net operating income a building generates. You can do different things, of course, to adjust that to come out to a favorable net operating income. Of course, you can do things on the top line with respect to revenue, for example, by as occupants turnover, and you can charge market rent. That helps with the revenue side of things. But even the bottom line, on the expense side, you can find ways to include and improve on efficiencies of the building, right? Which again will save on expenses, which again will help further drive a higher net operating income for the building. And when that appraiser comes in and they're evaluating that building, it'll be a lot more favorable, given obviously the the improvements that the building has made. So I hope that kind of answers your question at a high level. If you want to go into more deeper detail, of course, feel free to ping me offline through Ahsan, and I'm happy to dive into that as well.
Right. Thank you, Siptin, for that question. And we'll take one more question from Mohammed Salman. Thank you, Mohammed Salman, for joining. Any risk you see for investors in a current market situation? It's a bit of a
yeah. I think with respect to just the apartment fund specifically, again, because of the headwinds right now in the current market situation, it's actually helped benefit our fund more than anything. We've got an overall occupancy across the board of just under 99% in our fund right now. And simply because, again, I think, you guys will understand a lot of the challenges right now with respect to just, home ownership and just the cost of just being involved in the real estate market, right? And then, of course, you'll understand that there's still a lot of supply imbalances right now. Right now, a lot of developers have either pulled back on their projects. They're not even launching, which means it's going to delay the ultimate build out of development and stock, right? That we're bringing to the market, which is again going to further amplify the challenges that we're already facing. But again, in a roundabout way, this is actually helping our apartment fund because, of course, ultimately people need a place to stay. It's still relatively affordable. I mean, our average monthly rent across the portfolio is around $1,500 a month. So still fairly affordable, in comparison to some of the rents that you're seeing in the downtown Toronto cores, or even some of the other downtown areas across the Ontario region. So, it's almost helped our apartment fund specifically. But yeah, in this market situation, it is a very tough market. I'm not going to sit here and sugarcoat that for you. But we've been able to insulate ourselves from that simply because of, housing is still in need. People still need somewhere to live. And, we provide a really strong option or alternative, I'll say.
Perfect. Thank you so much. So that wraps up the Q&A session. I want to thank everyone for jumping on the call here. I know it's a Saturday morning, but really appreciate you taking the time. Thank you, Cosme, for the wonderful presentation. Like I said, if you have any questions, you can always reach out to me offline, and I'll be happy to connect you with Cosme and Equiton. Just a couple of quick reminders. Number one, if you're on this call, just want to let you know that I do what's called a real estate action plan. It's a quick 20 to 30-minute individual call with each person where we discuss your existing assets and liabilities, your real estate portfolio, and try to figure out a way on how we can help you build wealth through real estate, whether it's through traditional single family or even through Equiton, and giving you different option ideas to help diversify your portfolio, and also, like Cosme said, give you some passive income options. So if you're open to doing a real estate action plan, just send me a message offline. It's completely complimentary, and for my clients who I've done that with, we've found some great results. Whether even if you're not looking to invest right now, it's just a kind of great way to recap your situation and build a plan for you going forward. Second item on the agenda is that we are going to be doing more events. So every 90 days, be on the lookout. We'll be having in-person events and also online webinars on different topics. And if you guys already know, I do a monthly podcast. I'm just going to be sending you a link in the chat right now. If you get a chance, if you found this information valuable, please go on that link and do subscribe to the channel, and we get more information like this that we had today. And last but not least, we will be sending each one of you guys a recording of this session in case you had to miss out early or leave early. You get full recording. And I want to thank everyone again for joining. Really appreciate it. Enjoy the rest of your weekend, guys. Have a wonderful day, and we will be in touch. Thank you so much. Thank you, Cosme.
Thank you.